Welcome to this market and economic update. In this video, we'll discuss November's market volatility and what it means for investors as we approach the end of the year. While major indices have delivered strong year-to-date returns across stocks, bonds, and international investments, November brought a brief period of volatility that affected many asset classes. Investors continue to worry about artificial intelligence-related stocks and the path of the Fed rate cuts. At the same time, the government shutdown delayed the publication of key economic reports, making it more difficult to judge how the economy is doing. Despite this market volatility, many asset classes stabilized and rebounded by the end of the month. Over the next few minutes, we'll walk through what investors should keep in mind. November saw investors temporarily move away from risk assets such as technology stocks, high yield bonds, and cryptocurrencies. This was primarily due to questions around the sustainability of AI investments and investors adjusting their expectations around upcoming Fed rate cuts. AI related stocks experienced their worst week since April. Concerns about spending levels, profit margins, and questions around a potential bubble created volatility. Yet beneath this, many fundamentals remain strong, with companies such as Nvidia reporting healthy revenue and earnings growth for the third quarter. Cryptocurrencies experienced a sharp correction during this risk-off period. Bitcoin fell over 30% from its early October highs, briefly trading below $85,000. While the adoption of cryptocurrencies by investors has grown, periods such as these demonstrate that these assets can be highly speculative and prone to boom and bust cycles. This chart shows that the S&P 500 has experienced 6 pullbacks of 5% or worse this year. While this is the worst since 2022, it's also not far from the historical average. For investors, this is a reminder that brief periods of market uncertainty are completely normal. Shifting to the economic data, the longest government shutdown in history ended after 43 days, but the federal government will only be fully funded through the end of January 2026. This means that political uncertainty will continue to be a source of investor concern. For investors, the bigger challenge is that the shutdown delayed some key economic data. For example, the delayed September jobs report showed that the economy added 119,000 new jobs, and the unemployment rate ticked higher to 4.4%. It's the highest level since October of 2021. Although still low by historical standards, a full October jobs report will not be published since surveys were not conducted during that month. This lack of data makes it more difficult to understand exactly how the economy is performing. In particular, this impacts the Federal Reserve, since they will enter their mid-December meeting without the full economic picture. Expectations for a rate cut at the next Fed meeting have shifted wildly, with market-based expectations now suggesting the Fed will cut rates in December, and then again in April or June of 2026. Still, November's market volatility and ongoing uncertainty are reminders that swings in the stock market are normal. For long-term investors, this underscores the importance of maintaining an appropriate portfolio that can navigate the ups and downs of the market. We hope you found these insights helpful. If you would like to discuss any of these topics, including how your asset allocation looks going into year end, please don't hesitate to reach out. We look forward to speaking with you.